Hey everybody, welcome to the morning market briefing. It's Friday, February 20th, 2026. Hope you're doing well out there. Tom, how we feeling?
Feeling strong. We're waiting for some
We got a lot
some
of
hot
data.
data coming in.
We got data coming in. Going to get a good look, I think, at least with some relatively recent. Maybe it's not real time, but it's meaningful. We're going to get a good look at how the economy is actually doing. We're looking for PCE coming through. We're getting GDP this morning. What do we got first, Tom?
So let's start with inflation. So I'm looking at the data here. A little bit of a surprise. So the month-over-month PCE on the headline number was expected to come in at 0.3. It came in at 0.4. And this is for the month of December. On the year-over-year, we came in at 2.9. Expectation was 2.8. And then the core PCE month-over-month, same scenario. 0.3 was the month-over-month expectation. It came in at 0.4. And then the core PCE year-over-year expected to come in at 2.9, came in at 3. And so a little bit of an uptick. The previous reading on core PCE was 2.8. Obviously, the data's been a little bit messy. We had that hot surprise on PPI, which I believe is probably feeding into this. The bond market is not reacting very strongly to this, in the sense that, we were at a 405 and change when before the data came out on the 10-year. We're now at a 406, so we moved up, call it a half basis point. Front end is functionally flat, so there's no change in terms of wiping off cuts. Potentially, if there was more fear of that, I think we're seeing a lot more movement on the front end. So I think everybody's reading through this, which is to say we had a little bit of a hot PPI. CPI, is obviously cold, and that's really the one people are more focused on. And the PCE obviously was a little bit higher, but I'm interested to see what the rounding to a number of digits would be, because if it was 0.3 and we came in 0.4, it's very possible it could have been 0.36.
Yep.
But suffice to say, I don't think this is a number to worry about. We've got an interesting situation at the Fed. I'd actually, it's a little bit of a divergence from the notes, but there's been a lot of chatter about, we talked about Kevin Hassett disciplining the New York Fed. Well, Neil Kashkari came out and basically said that, Kevin Hassett is an idiot, and that criticizing the New York Fed is divisive, and throwing out the often used saying he basically is undermining the independence of the Fed, because Kevin Hassett. So we're in a position now where there's all kinds of infighting at the Fed, and it's become extremely politicized. And Brian Westbury, who's an economist we like, put out a tweet that I definitely think is worth reading and thinking about, because there's been so many bad moves that the Fed has done, and so many bad moves that the government has done that the Fed has said nothing about for a very long time, and they've managed around it, and they've stayed very neutral. But we're heading into an era now where there's a lot of politicization of the Fed. I mean, even the notes that we got, the minutes from the Fed meeting, that there were Fed members who were in favor of hiking rates, really doesn't make any sense, because if you think back to prior to the election, they were cutting rates, and they were in favor of cutting rates ahead of an election, which was seen as a political move, despite the fact that inflation was noticeably higher than it is right now, which is, I would argue that it's hypocritical. It's to say, hey, if inflation is 3.5 and we need to cut rates, then why is it that we're so adamant that we need to put fair language in to make it difficult for Warsh to cut rates when inflation is, call it almost a point lower now than it was then? And so that's kind of the breakdown. And we got an email from a super user today, said, hey, maybe we should do a one-off podcast where we really break down the Fed. How does someone become a Fed member? What are the machinations of that, and why is it becoming so politicized? And if we went voting member by voting member,
what do they think?
How would we paint them in terms of their political stance? But this is sort of a long tweet from Brian Westbury, but I think it's really on the nose. But he said, in my 40 years of being an economist, I've never seen the Fed more overtly political, nor have I seen a battle like this erupt between the Fed and the White House. The Fed has always had an unwritten rule about commenting on fiscal policy issues. It quietly supported TARP. It ignored the Obama tax hikes, the massive Biden deficit. It ignored millions of illegal immigrants crossing the border. It ignored hundreds of billions of spending and subsidies being shifted towards solar and wind, which are less productive than fossil fuels. It monetized the spending that was quantitative easing. It cut rates before the 2024 election, which it has always tried to avoid. Now some of the Fed are saying that they want to raise rates due to fears of inflation, even though inflation was higher in 2024 when it cut rates. And the Fed can't shut up about tariffs. It is patently obvious the Fed has decided to play politics. They will argue that Trump started it, but QE actually started it. The Fed funded big growth in government and deficits. For Kashkar to blame Hassett for undermining Fed independence is laughable. No one should know the names of the people on the Fed, but these people are trying to be controversial. They want to be political. The Fed's balance sheet must be trimmed, along with many thousands of Fed staff. It's absolutely untrue that the world is safer because of the massive increase in the size of the Fed's balance sheet. The Fed is full of itself. I want a smaller, humble, quiet, and much less active Fed. I couldn't have said it better myself. In fact, I said it worse right before reading that out loud. But it's true. I mean, we used to not think about the Fed at all.
At all.
And now it's become the central focus.
And
People
not
in
just the
street
Fed as
talk
a group,
about it.
but the Fed individuals are a major talking point.
Yeah, 10 years ago, I could tell you who the Fed chair was, and that was really the only important person to know. Now you have to know what their political leanings are, what their mortgage situations are, how they view the president, and how they're going to go to war with him, and how they're so independent. It's become an absolute clown show, and I agree with Westbury. I think this is it makes no sense. They're not making moves that make sense economically or based on the data. They're making moves based on the fact that they don't like Trump. They don't like that he's called into question their ability to do their job, which should be called into question because they're not doing a very good job in many cases. And so it's just it's become a mess. And we just need to go back to a quieter Fed where they aren't on the star of the show. We don't have to do all these economic projections. We don't have to say, hey, we're not even thinking about cutting rates or hiking rates. We don't need to know what they're doing because they need to make those decisions, because the less we know, the more those decisions will have an impact on the market because it adds uncertainty and it makes them more effective. End of rant. But still, so insane, I think. Just so silly.
All right, we've got GDP coming through, and this number is pretty shocking. On GDP, our last reading for Q3 was 4.4%, I believe. We were looking for
2.8.
2.8. The reading for Q4 is 1.4.
We're going to need to do some digging on the numbers.
Well,
there.
I've got a number here for you.
Okay.
So final sales were down a little bit. Consumer spending up 2.4, notably higher than the 1.4 figure. PCE largely in line, a little bit higher, as we just alluded to. Core PCE largely in line. Here's what's interesting. The GDP deflator, which is the mechanism they use to essentially strip out the impact of pricing changes. Inflation is the thing that people remain worried about. The expectation was that it would be a 2.9. It's a 3.7.
That's interesting because if you look at core PCE year over year, that number is 2.9.
So we're stripping out 0.8 right off the top. You also had it was widely expected that the impact of furloughed employees, government shutdown, et cetera, would be a drag, potentially as much as 1.5%. But what's interesting is this is just such a stark contrast to, a 3% figure that we saw from GDP now on the projection as of yesterday. Where are they getting this deflator number of 3.7? Because it's supposed to track inflation, and it presumably is off a different basket of goods than you would see on CPI and apparently PCE. That 3.7 figure, I just don't think either you or I or many listeners of the call think GDP should be deflated by 3.7%.
I mean, if you look at just the breakdown that we did last week of CPI, the things that were above that number, electricity, maybe natural gas, everything else is down, including housing, which is the biggest piece, was only at 3.2 annualized. Yeah. So you're adding an additional, call it 10% on top of that, which is the biggest driver was at 3.2, and yet somehow their number for the deflator was 3.6. So I would expect this number to be revised up later. I think that But here's devil's advocate. The haters and losers, of which there are many, who want to hike rates.
Tough time to do
Tough
that.
time to do that if GDP is actually 1.4% in the fourth quarter. That would indicate they actually need to cut rates aggressively.
Yep.
So sorry, ding-dongs, you were wrong again.
We don't think this number's right, but if it is, you were wrong.
Yeah, the irony is that your fake news high inflation number actually pushes you in a direction where you would need to cut rates. By making up a number that is way higher than inflation and using that as your inflation deflator, you actually push GDP down, which would be an indicator that you would need to cut rates.
This is
great job, ding dongs. You did it again.
I am as confounded by some of the data we've gotten in the last 10 days as I have been at any point in my career.
This is a wild number. It's so far off of all of the estimates, including the investment banks.
I don't know. I mean, I'm questioning myself on a lot of things right now because I would say that the employment picture is quite weak. And last week they told me it's very, very robust and very powerful and strong. And I would say that economic growth is quite strong, and they're telling me it's very, very weak.
They're telling me inflation is very, very strong, but it actually is very, very weak.
Yeah.
This is a conundrum, folks. This is why the bond market is not reacting, because it doesn't believe this number. If it did, you would see the front end collapsing because GDP is so low. I mean, or I guess maybe because inflation is so high. I mean, it can't be both. It can't be both because the numbers just don't add up.
We're seeing very little movement on the equity futures as well. I mean, they were down a little bit before we started the call. I don't know, guys. The question is, how strong is the economy? And equity futures rising a little bit, actually, perhaps on hopes for more cuts.
Let me take a look at the at WIRP, as we call it, the expectations for cuts. We are at 2.29 for the year, so slightly fewer cuts than earlier this week when I think we got about to a 2.5 as the high point for the week.
So people are just not.
People don't care about the data. Because you know who doesn't always care about the data? The Fed or the people making the data, it seems. So,
all right.
Moving on.
Yeah, let's talk about Indonesia. We're seeing some de-escalation continue there. Trump is meeting with the Indonesian president. You want to take a shot at that name? Prabowo Subianto?
Yeah, that was pretty good. I would say Prabowo Subianto. I'm not sure what.
They're lowering the tariffs from 32% to 19%. In exchange, they're going to purchase $33 billion in American goods such as energy, agriculture products. $15 billion going to oil and gas, $13.5 going to commercial aircraft, and $4.5 billion in agricultural commodities. So Indonesia also cutting tariffs on 99% plus of U.S. goods, and they're removing. We haven't seen this language in a while, but they're removing the non-tariff trade barriers. So that'll help narrow their $16 billion trade surplus with the U.S. We're in a rotation of de-escalation, it seems, from Trump, which flies in the face of the hawks out there that are really looking for a war with Iran. Kind of want to jump there because I do think that's top of mind. I will tell you that I don't know how to read this. It certainly seems like military action of some shape is almost inevitable. I mean, one of the things I always talk about with Trump is just what's he saying over and over and over again, and what does history say about when he says those things over and over and over again? Well, we kind of know his approach to military action with Iran. We saw that last summer. He certainly is very much in the camp of we'll get a deal one way or another. So part of me thinks something is going to happen. What's giving me a little hesitation on that is much of the online narrative of why something is going to happen is because of heat on the Epstein files. They think, hey, we got to get a distraction here.
And ICE. I've also seen that suddenly people aren't talking about ICE. The blue hairs are mad about war with Iran now.
Yep. Yeah, so we've switched gears. I don't as little confidence as anyone out there may have in President Trump, and I think you're perfectly allowed to have that opinion. I still refuse to think that we're in a country in which the president would start a war so that people would stop talking about Jeffrey Epstein's emails.
I mean, I don't know.
I'm just going to go out on a limb.
Bill Clinton did it with Kosovo. There's a little movie called Wag the Dog. You should go watch it.
Yeah.
I can guarantee you that the young boys are not familiar with that or have ever heard of that movie because it came out in like 95, maybe.
Yeah.
So, but it's a great movie, but it's about them basically making a humanitarian bomb situation on a movie set that starts a war with I would call it a Balkan country. Is it De Niro's in that movie?
Yeah, De Niro. And who else?
It was one of those.
Dustin Hoffman.
Yeah, Hoffman. Yeah, it's one of those where your parents rent that movie and you're 1997. I would have been 11 for most of the year. It probably was like, man, this movie sucks.
This is so boring.
Yeah, I don't understand what's going on at all. But that's life. That's blockbuster life. You don't get a choice when you're in 1997. Children didn't have choices.
You should along for the ride. Do you have any thoughts on Iran? You think we're going to see something over the weekend?
I'm sort of on board with the idea that if you're seeing the military action, that's not where it's going to come from.
You've missed it.
Yeah. I mean, Trump has very much been hey, look at the hand, and then somebody else punches you in the back.
I mean, even yesterday on Air Force One, I actually thought this was pretty interesting, and it's one of the few things that Trump has been completely consistent on going back to 2015 when he was running for the Republican nomination. But he was asked by the gaggle on Air Force One about his criticisms of AOC. And they were like, well, what would you have said? And he said, this was a perfect question for her to not answer. In matters of war, I would never give an answer and let them know what the strategy is. I mean, as recently as yesterday, he was like, I would not let anybody know what is coming from a militaristic standpoint. And then people were like, oh, he's just telegraphing this one.
Did you see, he had a great quote yesterday where he was like, a lot of handsome men out here, a lot of handsome men. That's not for me.
Not for me.
I like ladies.
Lest there be any confusion about what gender President Trump is attracted to. He noted that there were some successful, handsome men and not his type.
Yeah, but not for him. Yeah.
So I thought, that was breaking news.
Not to my taste, but
Yeah. and then to add clarity, he said something along the lines of, I like women.
Yeah.
Blue Owl, private credit situation. How big of a blow up is this? What's going on with it?
So we're continuing to see a massive rush to the door on these private credit vehicles. And Blue Owl is probably the most prominent one right now. Apollo and BlackRock have products like this too. I think it's less about that there are big credit problems, especially in these bigger products. I think they are able to do deals that are cleaner. And for the most part, they're very diversified. I mean, there are a ton of different deals within these funds. The problem, I think, is that there was a big push for this. Everyone's like, man, this is the golden age of private credit. They got a lot of retail investors locked into these things. And they didn't explain to them the realities of these products, which is, one, it's going to be more volatile. It's not really fixed income in the traditional sense. It's not going to be a bond portfolio. These are loans made to individual businesses or, things that can't access the capital markets. We're buying, even if it's a junk rated bond, this is a company that is big enough to access the capital markets and use Goldman Sachs or JP Morgan to issue actual paper. And if something goes wrong, you at least have some way of being remunerated on that. This is not the case in private credit. And as a result, you kind of need to keep people invested because the liquidity is such that you can't just be buying and selling these things all the time because it's like me trying to sell you my couch. It's like the couch works great for me, but not everybody wants my couch. Yep. And so the market for that couch probably is going to mean that I'm going to sell it for a lot less than I bought it for, even though there's plenty of useful life left in that couch. So this is basically what's happening as the price action on these things is poor. People are scared. There's a lot of selling. And as a result, that creates more demand to sell. People don't know what they're in. The bond market is doing really well, but these are not. And I'm thinking, I want to change my allocation. I don't want to be in this private credit. I want to be in public credit. Well, you go to do it and you can't get out. And that creates more selling. And so the more illiquid something is, there's more sellers than buyers, the faster that drops. And the smaller the market, the more aggressive those drops are. So you have a combination of his bad performance plus worse liquidity. And what's really funny about the liquidations that Blue Owl did do is, I don't know if it's funny, but the biggest buyer of the credit they were able to sell was Blue Owl. They sold a bunch to another fund, so they got some new retail investors
fresh blood
to buy the garbage that their other retail investors didn't want. CalPERS, which is the pension system for the state of California, and OMERS, which is the largest Canadian pension, the Ontario Municipal Employee Retirement System, OMERS. So they basically sold it to people's pensions where you don't have the ability to sell it. So if you're Joe Schmo, you work for the state of California, you've got a pension. Now the pension manager of California has bought these products and put them to secure your retirement outcome. And that's a great solution for people who want to sell, is you put it in the pockets of people who have no ability to sell. And so I'm not often in agreement with Elizabeth Warren, but she put out a wonderful shrill tweet saying that Blue Owl needs to be investigated. Trump needs to put a stop to putting these private credit instruments into people's retirements account, to which I say, yes, that's correct. We need to stop doing this. I wouldn't do it, and I don't think you should either. And so she's right here. So 2 big wins for Elizabeth Warren in the last 2 weeks. One, that we need to break up the healthcare system, which I agree with, and that we shouldn't be putting private credit vehicles in people's pensions and retirement funds, because people just don't know. It's not like Apple. It's not like Google. It's not like City of Marietta bonds. These are esoteric instruments that these people do not understand. Most people don't understand.
Yep.
I wouldn't claim to understand.
Yep.
Or be able to trade effectively, and therefore it's bad suitability, which is, part of the criteria we have is fiduciaries is this a suitable investment for John Q. Public? And my answer would be no.
Yep. And it's frustrating because I think our industry does not do itself any favors, Tom. The number Hicks and I and a couple others from the office were out in Denver for a big Schwab conference, and this isn't a shot at Schwab, but in their exhibit hall, part of how they pay for these conferences is they sell booths to fund companies, to asset managers, to technology companies, all of the likes. The percentage of those in those booths this year and last year that were specifically there to market private credit to advisors who would then put retail clients into them was just absolutely staggering. There was a lot of content, the sponsored content, so to speak, where people pay for a speaking slot. A lot of that was private credit. And it was pretty discernible. I mean, one of the things I find most interesting about those conferences is actually walking around, seeing what the sponsored content is, because those are the products people are pushing, and they're pushing them because they've run out of the most sophisticated investors in the world. Now they're going down a rung and down a rung and down a rung. I would argue, no disrespect to any of our listeners or anyone out there, I would argue that 401k investors are the least sophisticated, and the reason I say that is that they are the lowest common denominator. Most people are put into a product, usually a target date fund, something pretty straightforward and pretty simple that is appropriate. But when you think about the investor base and you think of, okay, well, we've got people that are investing institutional capital, we've got people that are doing their own diligence and really managing their own portfolio, those folks are more involved at a significant level than somebody that works at any company out there that just has a 401k. And they've really broadened this thing out. And I think typically when we see that, the more something is being pushed to the RIA channel, the independent advisor channel, as opposed to the institutions, and the more things are being pushed into 401k accounts, typically that's the top. We're looking at something close to, at least for a near-term cycle, we're looking at something that's pretty close to the top. We've seen it in crypto time and time again.
I mean, yeah, when Fidelity offered to put Bitcoin in your 401k, it was $120,000 a coin. It's now, what, 64, 65? Yeah. And a lot of people, I bet, fired into that. Mm-hmm. And that was a great opportunity for people who are holding a lot of Bitcoin to realize their gains and move on. And now you've got a big loss in your 401k because you follow the shiny object. And I think it's a great way in our industry, and we don't do this. We aren't asset allocators, which is to say, hey, you come in, we have a model, you get 10% large cap, we put that in a fund, 5% mid cap, we put that in a fund, we have 12% international, we put that in a fund, and you don't select any of the stocks you're buying. We just say, hey, we don't care what the stocks are. We just want to have exposure to this area all the time. Well, how does that differentate? I could do that. You could do that. You could do that on your own at Schwab. You can go in and say, hey, I want a modern portfolio theory, pre-made model with a 70-30 mix, and they'll put you in that. And you won't make any decisions. You'll own a ton of stocks, tiny slivers of a million different things, and you don't know what you own. It doesn't really matter because it's just going to kind of go sideways forever. But if you're someone in this space and you have to compete with Schwab that can do that for you for a very low cost and you have to put zero thought into it, well, how much thought am I putting into that? The answer is zero. And so how do I differentiate myself? Well, I can get you this shiny, beautiful private credit thing. You can't get that on Schwab. It's awesome and it's great. Here's a giant stack of paperwork that says you can't sell it for 10 years. And if you do, you're going to take a massive hickey. Yeah. But it sounds really cool and interesting, and I'm doing something interesting. They're not. They're just selling you another product, which A, you can't get out of, and 2, they'll make a lot more money off of you. Yep. So if we buy you a share of Apple, guess how much paperwork you have to sign to say, hey, you can't get out of this for 10 years. The answer is 0. Or a bond. This is the differentiator for us, which is that
we click a button.
Yeah, we look around and we say, hey, what are the best stocks? We're going to pick the best stocks for you. We're going to put them in a portfolio, and if the things change, we're going to move them around, and we're going to do that based on your needs, as opposed to modern portfolio theory says you have to always have 5% emerging markets and 22% international bonds and 30% U.S. bonds. But not all U.S. bonds are cheap, and not all U.S. bonds are the best ones to have. And you need to be moving them around to make sure you're doing the right thing for your client. Otherwise, you basically are just a salesperson, which is what a lot of people in our industry is. And listen, sales is difficult. It's a real skill, but investing is a real skill set too.
Yeah. All right. We'll wrap it up there. Next week we do have NVIDIA. That'll be the big company report. I leave you with this. U.S. government spending in the fourth quarter fell 5.1%, biggest drop since 2020. So there you go. I think that's good news. Talk to you soon.